Countdown timer.
Oh, my friend.
Live
Hey,
at
guys.
5. Live at
There-
5.
There it is. Hey, guys, welcome to the show. Wow, I forgot my name. Jeb Smith, Josh Lewis here with your weekly update. Live at 5, talking real estate, talking mortgage, talking everything to help you with the home buying process. Josh, welcome to the show.
It sounded a lot like, Jeb, that you were going to try and claim to be Josh there for a minute. That's what my concern was.
The real concern is that we've been doing this consistently for about 7 or 8 months now, and I still don't have the hang of it. That is more of the concern than anything else that's going on. But anyway, we appreciate you guys being here. Appreciate you watching the show as always. There's a lot of data coming out on all fronts always, and we're going to get into some of it tonight. But for those of you who are new to the show, put your comments in the comments section. We'll do our best to get to those in a timely manner. We'll try to keep our answers short and give you the information that you need. But I want to start tonight by talking. What is Josh doing there? What are you throwing around, bro?
Sorry, brother. I didn't mean to put it live. I was going to queue it up for you to share.
Wow, this guy is taking over the show here. This guy thinks it's his show now.
I'm executive producing back here.
He shows up on Wednesdays, and all of a sudden he thinks it's his show. So anyway, I have no idea where I was even going with that because he completely threw me for a loop. But no, what I was going to say is a lot of data out there, information that we talk about every week. Josh is going to talk about rates, going to talk about the future of rates, which we always do. But yeah, I posted a video earlier this week talking about seeing more inventory. So I've started to see a little bit more inventory in our market. What I thought was somewhat not of a slowdown, but I've seen inventory increase 40% in Huntington Beach, about 20% as a whole in Orange County. And I'll look up the numbers here while Josh is talking in a minute to give you a real live update of what's going on with that. But then again, I put in an offer on a property yesterday. Again, it's in the lower price point of homes, around $600,000 here. It's actually in Long Beach. And there were 38 offers on that particular property. Now, Josh will say it's a little unique in the style of it or whatever, but I looked up comps. There's a lot of them that have sold, and I was really surprised to see things move that quickly in an environment where I thought things were kind of slowing down a little bit. But we'll take some time and talk about all of that as well. Josh, why don't you hop in here and give us your mind? What's on Josh's mind tonight?
Well, again, I will say Jeb thinks it was an average home. I thought it was a super cute little house, Spanish style in North Long Beach. We were talking earlier, we saw in the news here, for those of you in Southern California, North Long Beach was previously the least desirable area of Long Beach, and a lot of areas in SoCal, and I'm sure around the country, areas that used to be less desirable because they are more affordable are getting more and more desirable. People have in the past called it gentrification, but what happens when prices go up? People who make an otherwise really good income, and Jeb, the house was $550, it probably sold $560, $570, somewhere in that range.
No. It was priced at $519, which I thought was low. Maybe a little bit more. We offered $585, and comps supported a number in the low sixes, but she made it sound like nobody was even close to the offer that they considered. So kind of blew everybody out of the water, if you will.
So call it six and change, 6.25. Think about that. We're talking about an area in North Long Beach that was previously a less desirable area. The alternative is to be somewhere in more traditional Long Beach, which is $750, $775, $800 to get that home. So think of the home buyer that's buying a $625,000 home. It was actually the buyer that we're helping here. She's got great credit. She's got a great job. Just wants a nice place for her daughter. So you look at it. And it's still definitely an interesting market. So it was a unique property, something that anyone that saw that was open to the area and the bed and bath and square footage, no one would have walked into the house and said, this isn't what I was looking for. But even at that, 35 is strong. So Jeb and I had this conversation over the weekend of saying, he went through the same numbers here. Hey, I'm running through this for the show, seeing about 40% more inventory in Huntington, 20% higher in Orange County. I said, okay, well, what does it mean? if we had 100% more inventory, if it doubled, I mean, we were under 2 months inventory. So to get to 3 or 3.5 months, it has to double. I don't think we're necessarily seeing less demand in our local market here. We are seeing somewhat less demand, but why is that? We had a year and a half, almost 2 years worth of buyers all come into the market at the same time, end of last year, first part of this year. Some of those people gave up. Some of those people won the bidding wars. Some people got priced out of the market. With all that, we still have solid demand. We get inquiries every day from people wanting to buy a home. It definitely is a challenging market. Supply demand is changing, but our best case is getting to somewhere more balanced of 3 to 4, 5 months of supply. To call it a balanced market is 6 months. I mean, I haven't seen an offer, Jeb, from any of our buyers that has had less than 7 to 10 offers. Everything has been a multiple bidding. You're talking to the listing agent, you're assuring them we're exceptionally well qualified, and we will get the deal closed for them, and how our buyers can work around it. So definitely some changes to the market, but I don't think it's a fundamental shift to the market, more so just a normalization from a really insanely hot winter and spring due to people not being out and buying last year.
No, absolutely. And I actually looked up the numbers here while you were chatting initially. And at the beginning of the week when I did those numbers, I think my local market, 169 or so active properties on the market. As of today, 163. And with that said, there are 6 new listings on the market as of today. So that 163 was actually 157 as of yesterday. So while we did see an increase in inventory, a lot of those properties that came on the market looks like they've gone into escrow. Orange County as a whole, 2,600 homes on the market today at 2,499. So new properties come on the market every day, but when demand exceeds the supply, when the number of people going into escrow exceeds the number of properties coming into the market, that number is going to gradually go down. So we are seeing an increase, but it looks like there's still buyer demand out there, which is keeping things moving along. So let's jump into some questions here, Josh. We got a lot of regulars here. We appreciate you guys being here. Joey Crack, I think the most important thing is he's changed his photo, and I think he did it for you, Josh. I don't see any other reason why he would change it.
I appreciate that. Although his newborn is growing fast, if she's on his shoulders like that, I mean, this is like what, the baby's born a month ago?
Dude, they breed them for their athletes up in New York. They're
time flies. She's growing like a weed.
Yeah, there you go. The days are long, the years are short, they say. Anyway, appreciate you being here, Joey. We got Catherine saying hello. Thank you, Catherine. And Jennifer saying I have a skinny chin. Skinny chin. We'll take a skinny chin.
You went from a fuzzy chin to a skinny chin.
Hey, listen, skinny. And did she delete her comment? No, I don't see it anymore. What happened to it? My skinny chin. Oh, there it is. Here we go. Anyway, let's get in here. The reason people are here.
I thought maybe Nightbot put her in check and got rid of that comment.
No, Nightbot is nice to her. He's nice. All right. So let's see here. Tanner is asking, do you think buyer demand is significantly lower and will it come back? So we just kind of talked about that a little bit. I think buyer demand is there. Now, while I think buyer fatigue is a real thing, people getting out there, getting frustrated with the market. But my belief at the moment is if you're a buyer, you're a buyer. And what I mean by that is you might say, I'm not in the market to buy a house because of X. But if the right house, the right opportunity presents itself, my guess is that buyer would still take advantage of that property if the circumstances would allow them to do so. Now, you'll have some people that have to sign a lease extension and what have you, and that's going to take those people out of the market. But that's a whole different scenario. That's maybe they had to make a decision by a certain period of time in order to to purchase a property. And if they couldn't find it by then they had to do another rental or whatever. Yeah, you're going to have some of that, but I believe buyer demand is still there. And we've seen a drop down in interest rates. The latest stat that's come out said that, mortgage applications have jumped by 20% in the last whatever. Now it's primarily refinances, people refinancing because rates have come back down, taking advantage of it. But you have a lot of people that, rates came down and properties in some markets are starting to sit a little bit longer, giving these buyers an opportunity to maybe take advantage of what's out there. So I think buyer demand's there. Is it headed lower? I don't think so at the moment. You got some affordability issues in some markets, but I think as things mitigate, growth slows a little bit, you'll see those buyers, if they're able to, they'll still purchase. It's crazy at the moment. Josh, anything you want to add to that?
Yeah, you mentioned that the refinance applications were up 20% last week relative to the prior week, but purchase applications were up 8%. Again, there's still, it's not like, I guess I want you guys to understand that what are we comparing it to? Is demand down? Yeah, it's down from what? Is it down from last fall? No, it's down from the insanity of January, February, March, where like everyone in the world decided they wanted to buy a home at the same time. Or a lot of that demand was people who had kind of put it on hold through the holidays, came firing back into the market with the people who had always planned to buy in 2021. So demand is still strong. It's lower than that insane 3 or 4 month period that we had, but still strong. Supply is a little bit better, but it's not massive. And again, a lot of it comes back to people keep saying, well, why aren't people selling? Why are sellers staying home and keeping their property? I can tell you, I'm an example of that. I'm not terribly old, but this year will be our 18th year in the home. And for us to find something that would be significantly better in the current market is $700,000 to $800,000 more. You know, I can find a lot of things I would rather do than finance $700,000 or $800,000 more of mortgage to buy a home that is, 20% better, 25% better. So I think a lot of sellers that have been in their potential sellers that have been in their property for a long time are just saying, hey, you know what, my house is good enough. We saw, people, you guys often ask here, are we going to have a big bubble? Is there going to be a meltdown? A lot of people lose their homes. Home buyer behavior through 2014, 15, 16, 17 was much different than what we had in 2005, 2006, 2007. People learned and watched and saw what happened, and we never saw the people just going nuts. I mean, I had people that were first-time buyers in 2003. Home goes up $100,000. They want to sell and buy a $300,000 more expensive home, which is like double the price. I don't know about you, Jeb. I haven't seen a lot of that behavior. Most people are like, get me a nice house for my family and I'm going to settle in for a while. And they have, and they've built up a bunch of equity, and it makes it pretty tough. Just like a first-time buyer doesn't want to jump into the super high price point, a move-up buyer doesn't want to look at a $500,000, $600,000, $700,000, $800,000 gap to get what they initially may have thought was going to be their next home.
No, absolutely. You said two things there that I want to talk about. The first thing you said is where did buyer demand drop from? Right. I think that's important to note, because when you see these headlines out there and we talk about the media and what have you, they're going to spin it. Right. Because a lot of times they talk year over year and they talk month over month. And so when you see, buyer demand has dropped year over year, think about where things were a year ago. Now, a year ago, it was the middle, Corona was still a real thing and what have you. But as we move into the fall, where we were at the height of some of these numbers, they're going to spin it and say that, demand is significantly down compared to a year ago. Okay, but it's relative, right? We had a crazy, crazy environment at that time. And I don't feel like it's fair to compare those numbers, just not like it's not fair to compare April of this year to April of last year. It's a completely different environment, right? So when you're talking about those numbers, make sure you're looking beneath the headline, so to speak, and make sure you're really understanding what they're looking at. Now, buyer demand might drop month over month or what have you, but like Josh said, it's where was it at, right? I mean, we've had crazy demand. Demand last month, even though it was less than the previous month, is still significantly higher than it's been probably in the last 2 to 3 years. So coming down off of that isn't that crazy. And the second thing you said is talking about financing an additional 5 or 6 or 700,000. That's one thing. The property taxes is the big thing, right? That is the killer for most people. I mean, quite frankly, if I'm being honest, transparent here with you guys, that's the killer for me. My wife is looking at properties every day. Well, I mean, honestly, like pulling, every day she asks me about a different property. And I'm not worried about the housing market. I'm not worried about buying a property in this environment as far as the price goes. I just don't want to pay the difference in the property tax, right? Because I happen to buy my property, my current residence, at a really good time in the market in 2012 before things changed. And it's, I'm talking 3-4 times property taxes if I purchase something else in what would make sense to move. And I think that's the kicker for a lot of people. And so, I've got a low rate on my mortgage. My property taxes are based off X of when I bought it. And so I'm going to stay put. And I think you're going to have a lot of people that are in that position that would consider selling, but it just doesn't make sense financially to do so. And that's going to continue to keep some of that supply off the market. Even as things shift and change and people want to make moves, that's going to be in the back of their head, right? Because you don't want to spend a lot more money for something if you're comfortable, right? I'm comfortable. Could we use more? Absolutely. But we don't have to have it. And I think that's important to keep in mind as people are out there looking.
And let's actually talk about real numbers on that. We talked a few weeks back that we're putting in a pool at my house. Well, I would like my house to be a little bit nicer and a little bit more comfortable without having to pay all that money. It's going to cost about $100,000 to put the pool in. So let's quantify the difference. My taxes would, to move to the home that I would be willing to move to, my taxes would triple. So I'd go from about $750, $800 a month to $2,500 a month in property taxes. $1,700, $1,800. I can buy a lot of pool for that amount of money and pay it off relatively quickly and enjoy it forever and add some of that value back into my home. So I don't think you and I are unique. And this is a California issue. So if you're in other parts of the country going, why in the world would your property taxes go up so much? We have Prop 13. Your property taxes after you buy your home can only go up 2% a year. But if you sell that home, go buy another one, you're going to the market value. So even though my home is worth X, we only pay taxes on about $700,000 of value. To move to something that would be worth moving to is like $2.1 million. Not only a big payment, it's a monstrous tax bill also. So it explains a lot of why we're not going to see a monstrous amount of supply coming in. And I guess the other thing, Jeb, that you and I talked about earlier, people haven't been asking as much. We're saying, when is the monster supply wave coming from foreclosures? Due to forbearance once it ends. So we're going to have forbearance. The CARES Act forbearance is ending. Foreclosure moratoriums are supposed to end by the end of the year. But if you look at all the numbers, we're down to 2 million people in forbearance. The vast majority of people that went into
I think it's 1.7 is the latest.
Okay, so the number keeps going down. People are exiting forbearance. We're doing a lot of refinances for people that took forbearance last year. Some were just scared. Some of them wanted to take advantage of it, didn't really need it. But once you've made 3 on-time payments, rates are really low. So you can either leave that little extra $10,000, $20,000, $30,000 balance on your mortgage. For the most part, most lenders are not charging interest on that separate balance. You can leave it there. You can refinance, roll it back into the loan, and still drop your payment. So we're just seeing a really soft landing. There will be, I don't want anyone to expect foreclosures because we're sitting on record levels of equity. We've never had more homeowners equity ever. So even if you took forbearance over the last year with a 14, 15% appreciation over the last year, you have more equity than before you went into forbearance. So when we look at that, we may have forced sales, people that end up having to sell their home because they don't have a way of making the monthly payment. But we're not going to have a wave of foreclosures.
No, agree. And one thing I mentioned earlier to Josh is that September seems to be the month when the majority of these forbearances are going to end. So you're going to know here in the next 3 to 6 months what the effect of those are, because that's the majority of them are going to hit the market in September. So October, November, December, if you see more supply come to the market, might be a result of that. If you don't, you're likely not going to see really any from it. But let's move on here. Scenario: buyer let the seller stay on the property after the close of escrow for a month. How does the buyer access security deposit from the seller if the seller leaves the property damaged? Standard SIP, seller in possession, signed. So in theory, there should have been yep.
But before you answer that, let me ask. So saying, how do they access the security deposit? How often do you see with the seller in possession a deposit being made in a market like this where the sellers have all the strength?
Not that often. It does happen, and often sellers go, why would I leave a security deposit on my own house? Like, it makes no sense. In fact, I've recently had one where that scenario came up, where the buyer wanted my client, the seller, to do a security deposit, and we ended up agreeing to it because it was easy to agree to it versus going back and forth in negotiation. And my clients were like, we're not going to leave the property trash, so it doesn't really matter. They ended up not being able to close on time anyway. And so they didn't need the full rental. My client didn't need the full 2 weeks back. They were only going to be there for like 5 days. And so part of us going back to them was like, hey, listen, we're okay with your client closing later than they were supposed to, but we're not doing the security deposit. And they were like, okay, all is good. And it ended up being fine. Another scenario actually happened in there, and I'll bring that up a little bit later, which is actually something that's never happened in my career, which is funny to talk about. But how would you access it? If there was a security deposit left, it would have been left with escrow. So escrow, third party, attorney states, maybe left with whoever is doing the closing there, so that, if there's a deposit on that seller in possession form, it would have been taken through the close of escrow, at which point, if there's a complaint, still two parties have to agree on the damages there, and the seller still has to release that money. They still have to release it from escrow in order for the buyer to get it. So it still might be a battle there. And if there wasn't a deposit left, then you've got kind of a tenant owner type issue that has to be resolved. And part of your purchase agreement is likely that you agreed to some sort of mediation, arbitration. And if you can't come to an agreement, then there's small claims court. So it's kind of a touchy subject. There's not really a clear cut answer, and this is the way you do it every time. It's just really going to depend on where the money was left, the buyer getting some sort of estimate of the damages, being able to provide that to the old seller, and two parties coming to an agreement. So hopefully this is just one of those asking for a friend scenarios and didn't happen to you. But use your agent, talk to the broker, and hopefully you have a resolution there. All right. Logical Thinker in Orange County. How many homes on average selling 3% above the asking price? With many homes selling 3% above the asking price. Are appraisals also coming back around 3% above the asking price? I've had very few appraisal issues this year. In fact, only a couple, and honestly, they were not that far off. Josh sees way more appraisals than I do, being on the lending side and working with tons of agents and that sort of thing. So Josh can probably give you a better idea on that one.
We've seen our share of appraisal issues. For the majority, most of them come in a little bit low when we have an issue. So I would say 40-50% of them are coming in at value. A very small minority this year have come in over the sale price. But when they're missing, we've only had one or two with a big miss. And the crazy thing is, agents and sellers lose their minds when the appraisal doesn't come in at value or at the sale price. And what we have to do is say, totally good. If the market supports an appraisal higher than that. We already seen, we've talked about this before. If we've got 20 offers, the market has dictated what the value of the home is. So unfortunately, appraisers have guidelines that they have to follow, which are based on comparable sales that have already closed. So we had one this week that it came in almost 10% low. Seller and their agent rightfully lost their mind because there were multiple offers on this property, only 4 or 5. It's in a less hot market, but in going through it, he's screaming, the agent screaming, saying, hey, I sent the appraiser all the comps they need to support the value. I said, cool, no, we have no problem then. Send them over and I'll send it in with a rebuttal and we'll get it updated. So one of the properties, our property was on a half acre. One of the comps was on 5 acres. I'm sure you can all understand that 10 times the land would have a pretty big adjustment. The other one was 4 units. Ours was 2 units. So when you look at what the adjustment were for those things, they all adjusted down. The other 3 comps he provided were pending comparable sales. They hadn't closed. And I'm sure they're in the same boat. They're all sitting here with a low appraisal going, hey, let's wait and see if someone else can close and provide the comp and support our value. So long answer to a relatively short question, no. The amount that homes are selling for on average above the list price has no correlation to what they're appraising for. Appraisers are doing their best to bring homes in at the maximum value. That example I just gave you, when we went through, we looked at it, one of my underwriters looked at it and we're like, that's as high as you can appraise this property with the closed sales that we have to work with. And that's what we see primarily when we have them come in short.
Got it. All right. Good answer. And we're going to do things a little bit differently tonight. We're going to jump around on the questions because, we're going to try to find questions that don't normally come up and provide answers. We'll try to get to them all, but, get to the ones that I feel like are the most valuable for most as we come across them so that they don't get pushed too far down. And now I lost it and I can't find it. So I'm going to end up just going with the question I said, but
go find it.
Yeah, here. Well, let's do this one real quick, and then I'll find it. How hard is it for an underwriter when you switch from a 1099 to a W-2? Same job, same work, no change there. So 1099 is self-employed. For those of you who don't know, W-2 is a wage earner. You get a paycheck, they take your taxes out, all that good stuff. So, what does it mean when you go from a 1099 to a W-2? And then maybe you can just tell us on the other side, flip side, W-2 to 1099.
So with an independent contractor, the issue is we need at least a 1 year, but generally a 2-year history of tax returns so that we can analyze, great, your 1099 says you brought in $100,000. How much did you spend to bring that money in on advertising, office expenses, office space, supplies, all that stuff? So if we went from W-2 to 1099, we can see how much you're bringing in. We have no idea what your expenses are. So that's always going to be a problem. We're going to need a year at a minimum if it's if it's this type of switch from a very similar job title doing the same stuff, but at least a year. Most often you're going to need 2 years on it. Now going the other direction, we don't have that concern. So we say, I was doing this job as an independent contractor and now the person is paying me salary as an employee. Now, if that happens a week before you complete your loan application and go into escrow, an underwriter may have some questions of saying, why? Why did your employer magically switch you from a 1099 independent contractor to a W-2 employee? And usually we can answer that. In this situation, with it being last November and we're already in July, we've got an 8-month history of it. It really doesn't matter. We've shown that you're on payroll. And again, what is an underwriter worrying about? That, hey, you're working for someone as an independent contractor, they throw you on payroll for 2 months for you to get your loan, and then they put you back on 1099, and we didn't get an accurate analysis of your income. So in this situation, no one's putting you on payroll for 8 months as a favor to you while you're out fighting in this market, or probably not going to do that for you. So in this situation, you got no issues. If you're going the other way, it can and will be problematic.
Got it. And just something I'm going to throw out there, guys. If you put a question in there one time, please don't put it in there multiple times. Kevin, I'm talking to you, my friend. We are going to talk about interest rates, but we're not going to talk about them right now. So hang tight and we will get to them. It seems to be probably the most common question that comes up. And so we'll do it probably about halfway through the show when the greater majority of people are tuning in so that we don't have to continue addressing that question. With that said, Nicole has a question here. If I buy an SFR with a permitted ADU, can you use the projected rental income to qualify, or does it have to be zoned multi-unit? Josh.
So on the purchase, you're not going to be able to use it as an ADU. Now, if you're in the ADU and you come back and you need it to qualify for a rental, and we have a 2-year history of it on a Schedule E on a tax return, we can use it to qualify at that point. But on the purchase, the accessory dwelling unit, it's not treated as a separate property for rental purposes.
All right. Good. Freddie's got well, not Freddie. Who has a question here? Oh, Jeremy has a question here. He's saying, how does one cash flow with those types of taxes and rentals in California, Josh, with property taxes being as high as they are? How does somebody cash flow a property out here in California?
So for us in qualifying, people always ask this, like, okay, so I have to carry that new $4,000 payment? No. On a purchase of a rental property, we don't have a history. So we don't have that tax return with the Schedule E where we can look and say, here's how much there was maintenance and here's how much went to the homeowners association. So what they do is they give you 75% of the rents, and that 25% accounts for maintenance, upkeep, and vacancies. So you're going to take the PITI. So let's take a super simple example. I always like this one. You have PITI of $2,000 a month. You have $2,000 of rent. So in that instance, we can only give you 75% of it. So that's $1,500 against a $2,000 mortgage payment. That $500 negative amount there is treated like any other debt. It's treated like a car payment, as if you had a $500 car payment and added in your debt to income ratios. So in terms of cash flowing and looking at it, that's why most of California is not great for cash flow real estate. We had someone ask a few weeks ago, hey, is it a good time to invest in Newport? So it's not a good time to invest in Newport for cash flow. It might be great great for having quality tenants and appreciation going forward, but cash flow is really tough in California. That's why we have so many people in California. Hey, I own my home, I want to invest. I'm thinking of going to Iowa or New Mexico or Florida. It used to be Florida and Texas, but Florida and Texas have gone up a bunch. So we get a bunch of questions about going to the Midwest and investing because cash flow is so much better. Your rents as a percentage of the PITI is just much better in other markets than what we have in SoCal.
Here's the one also related to taxes, asking about, does property tax amount carry over from the buyer to seller in California? Does a 2% cap not carry over? So it would go from the seller to the buyer, not the buyer to the seller. And the answer is no. Whenever you purchase a property here in the state of California, it's based off your new purchase price, whatever you buy the property at. In some cases, back in 2009 or so, when you could buy a property less than the previous owner owned it at, your property taxes would actually be less than the previous owner's property taxes in some cases. But right now, because properties are appreciating, people are paying more than the previous owner. Therefore, their properties taxes are reassessed based on the new value. And at that point, it can't increase more than 2% a year from that time forward. So it doesn't go the other way around. Unfortunately, that would be really nice if you could take the seller's property taxes.
And what the purpose of Prop 13 is we had, grandparents retire, their home's worth $15,000, and in the 70s, skyrocketing market, and it goes up to $65,000, and they can't afford the taxes that just went up 400% in 5, 6, 7 years. So the Howard Jarvis Taxpayer Association led a little revolt, and they passed Prop 13 that says property taxes can only go up 2%. Obviously, that's not good for the state because they're not getting to tax the entire value of all the real estate in California. So they're certainly not going to let you carry it over to a new property from a seller to an unrelated buyer. We have some carve-outs from a parent to a child, parent to a grandparent to grandchild, but those are changed now under Prop 19 that just passed last year. They have to owner occupy the property. So for the most part, the answer is no, because the state is looking for their opportunity to get that property assessed at its current market value.
No worries. Thanks for the history there. Joey, $10 super chat. Thank you, Joey. How do you get a study survey of a land lot and search unknown land issues, or can only owners do it? FYI, that's my prince on the shoulder. So earlier, Joey, well, he's same photo here. He's got a son on his shoulders, and the princess is a beast in her own right. Salute. So thank you again, Joey. The way surveys work here in the state of California is you basically hire a company to do the survey. Now, each state might work a little bit different on this, but here in the state of California, these are independent companies. They come out and they'll do a survey on a property. It's not cheap to do this. It's actually pretty expensive to do a survey on a property. The typical lot here in Huntington Beach is about 6,000 square feet, which is pretty low for the majority of people out there in the country watching this. I'm sure, and it's probably $5 or $6 grand to survey that piece of lot property to find out lot lines and what have you. Now, if you're talking about unknown issues and that sort of thing, I'm not sure about the survey companies and how they go about that sort of thing. Mainly it's to look for gas lines, water lines, that sort of thing is what you're surveying. Now, to find issues, Josh, any idea on how that works?
No. So really, if you're talking encumbrances, that type of stuff, it's a title search. And like Jeb went through with a survey, you're looking at where are the lot lines, where are any easements, any of that stuff. And in terms of having a survey done, a survey company will do a survey for anyone willing to pay them. Now you run into the issue of, if I want to hire a surveyor to go out and survey your piece of land, they're trespassing on your land if they're there without your permission. So with that, I don't know that we have a lot of solutions for it. But I will throw this out, especially just for you, Joey. I think we're reaching the point of over-analysis. If we need to get back on a call, we need to get you out there and just buy a house at this point.
There you go. All right. Jose's got a question here. When you refi, can you take it to skip 2 months of mortgage payments? So how this typically works, guys, when you pay your mortgage, you pay in arrears, right? So when you make your July payment, you're actually paying the interest from the month of June. if that makes sense at all. So when you close on a mortgage, for example, say your mortgage closes this month in July, typically your first mortgage payment would be due September 1st, right? Because the interest due from the month of July is built into the close of that property. You're going to skip August payment and you're actually going to make that in your September payment. That's the way it works. So Josh, can you actually skip 2 months in that case and pay that interest up front, or how does that work?
Skip is a lie told by our friends in the call centers that they love to tell you, we're going to skip 2 payments. You're going to get a refund of your impound account. It's going to be wonderful. You're going to have all this money. It can be done, but you're not skipping anything. As Jeb said, you pay it in arrears. So in that example, so we just rolled into July, but let's say we go into next month. You decide you want to refinance today. So we get rolling and we close it in the first 10 days of August.
Bro, why couldn't you just use my numbers, man?
Bro,
July.
August.
We want to close this month. I want to close this. How good of a lender are you? It is 7/14. I want to close this month.
So we'll use Jeb's example. We will close it in 10 days for you because we can, because that's what kind of lender we are. So you're not late at 7/14. If you're after tomorrow, you're going to be late. So in this instance, because we want to use Jeb's July figures, you will have a late payment, but you're not late, meaning 30 days late until we get to the end of the month. So if we close on the 25th and you have not made your July payment, you're skipping the July payment. You're also not going to make an August payment because the new lender doesn't want a 10-day mortgage payment. They want a whole month to accrue. So you're going to skip August, and the first payment will be September 1. So did you actually skip anything? No, because your current lender is going to give a payoff demand that says the principal amount due plus interest all the way through July 25th when we close. The new lender is going to collect interest from July 25th to August 1. So you're going to have 60 days of prepaid interest that are collected. So did you save something? You saved the principal portion of both of those payments that weren't required. So you basically got an interest-only payment for 60 days. But when we're saying we're skipping it, most people are saying, I'm going to add it into my loan amount. So a conversation I always want to have with our borrowers who are looking at refinancing is, do you really want to do that? Do you want to add anything into your loan amount? Do we either want to increase the amount that you owe to cover closing costs, or do we want to get a credit from the lender to cover those closing costs and take a slightly higher interest rate? The reason for that is most people are refinancing to save money. You would not be shocked, or you might be shocked to know how many people I have that over the last 10 years have refinanced 3 or 4 times, just a rate and term refinance, never took cash out. But a kid in the call center told them, skip 2 months, get your impound account back, we'll finance that all into the new loan, and they actually owe $25,000, $30,000 more when they bought their home in 2010. They did well. They rode that interest rate down with all of those refinances, but we really should be doing both. So are there instances? I had a client here in Huntington Beach that we did that last year. We set it up to skip 2 payments and to get his impounds back. And on a Fannie Mae loan, you're allowed to get $2,000 back through closing and have it not be considered cash out. Freddie Mac, you can get up to 1% of the loan amount back. So we set his up and added as much as possible in there. It was a high balance loan. We wanted to do rate and term and not cash out. But he had about a $25,000 project he wanted to do landscaping wise in his backyard. You just want to make sure the person that you're talking to can explain to you what you're skipping, what you're saving, what it's doing to your loan balance over time. And none of those options are wrong. It's not wrong to skip 2 months payments. It's wrong to not know what it's doing to your loan balance and how that fits into your long-term financial plan.
Good. Great answer. Yeah, working with a pro, right? I can almost assure you that a guy in a call center cannot answer the question of why you're skipping a mortgage payment. I mean, I just do. We should just call tomorrow to see if someone can actually tell you the answer to that, because I don't think they'll be able to. All right. Got a couple other questions here. Guys, we are going to talk about interest rates. Just keep that out there for those of you interested. Michael has a question here. Does a reference letter from your landlord help in getting a person approved for a loan? So the easy answer is no. But let's say, Josh, I don't have any credit history, right? You pull my credit report. I don't really have any trade lines. Does something like a letter from my landlord help? What would help in this instance to build credit? Because I think that's something that people need to know.
So,
or the answer is nothing these days.
Yeah, the letter does nothing. There are programs that will all, Fannie, Freddie, FHA will all tell you can get a loan without a credit score, without a credit history. The reality is very few, if any, lenders will do them. They're hard to sell into the secondary markets. Just investors don't want them because they don't really know what they're lending on. A letter from your landlord would be less helpful than 12 months of canceled checks showing you paid your landlord on time. So anything where we have someone that has a limited credit history, or a lot of times we'll get someone who has an okay credit score, but they don't have any trade lines that have rated. Like they just stopped using their credit and they only had bad credit in the past. In those instances, we just had a client of yours, Jeb, the guy that bought out in San Jacinto. We had to get alternative lines of credit, and a landlord can work for that. 12 months cancel check showing the payments on time, a cell phone, a utility bill, a gym membership, things that don't show on your credit but showing that you are actively paying bills on time can be helpful. But for the most part, we need a credit score, and a reference letter from your landlord's not really going to do anything for you.
All right. Good answer here. Let's see. Trying to find something.
Yeah,
go ahead.
No, we got a good one after that. I like that one too.
So my lender gave me a DU letter. Does this put me ahead of other potential buyers? So let's answer the question first of what is a DU letter. It's desktop underwriting. It's Fannie Mae's automated underwriting system. Freddie Mac has their own as well. So let me talk from the perspective of why we use this, and then Josh can talk about maybe why it could or could not be helpful just based on how lenders use it and the information that's input. Because we get this question a lot. But me as a real estate agent, why do I ask a lender to provide me that document? Because I'm trying to put a complete package together for the listing agent on the other side when I'm representing a buyer. What I mean by that is I'm trying to see full qualification, right? I'm trying to see the purchase agreement that they filled out. I'd like to see a pre-approval letter from the lender. And I'd like to see DU findings because I have a background in finance, in mortgage lending, and I understand how to read these things. Some don't. But what that document does is, for one, it shows me the credit scores. It shows me their debt to income ratio. It shows me the type of loan that they're using because, they might tell me on the purchase agreement that they're doing a conventional loan for whatever reason. I look at the desktop underwriting findings and find out they're actually doing an FHA loan. That makes a little bit difference depending on the type of property that is being purchased. So I'm just trying to find all the information that's possible. So when I provide one to the other side, I want to provide a complete package, right? I want the agent on the other side to know that I'm a professional, that I know what I'm doing, that I'm providing all this documentation in case they have any questions. The information's there. In addition to that, Josh is also calling my lender, whoever that might be at that time, depending on if the buyer had their own, is calling and verifying that information as well. But Josh, let's talk about desktop underwriting findings, DU findings, right? The information is only as good as the person that input it. You'll say garbage in, garbage out, right? So
1,000%.
Right. So it's easy to manipulate that document. It's easy to change the income on there to say X when it's not really X. It might be Q. Bad example, but it's easy to manipulate the data to make it appear more favorable in some cases. And so is it really, really beneficial? It depends. What's really beneficial is having two lenders, maybe the lender on the other side that's representing that the listing agent has as their lender, if you will, and that lender having a conversation about those findings and really coming down to the bottom of the details and to make sure that that person is truly qualified. But Josh, talk about DU findings a little bit and how easy it is to actually get the result that you want.
So desktop underwriter is an algorithm that's just going through and ensuring that everything that went into the loan application meets the loan program guidelines. So there's the simple stuff that's black and white. Person makes $4,000 a month. The mortgage is $2,500 a month. Debt to income ratio is too high. It'll come back and say not approved. Then there's the things that aren't black and white. We have a borrower with a 650 credit score. They have no reserves and they have a 42% debt to income ratio. Technically, all those things meet the guidelines, but oftentimes desktop underwriter or loan product advisor, Freddie Mac's version, will come back and kick those out. So when we're looking at automated underwriting in this context and the value of it for an agent to see whether the person is approved or will be approved, or will have a good time and easily get through underwriting, when I'm reviewing them for an agent who doesn't have the experience with financing that Jeb does, we're looking through for things that obviously don't look right. If we have two borrowers and they both magically make round numbers, if all of the bank accounts have exact round numbers, the DU findings will say where the bank accounts are held. If it just says checking and savings, it doesn't say Chase Bank or Wells Fargo. You start going, what kind of application do they have where they probably don't have the statement, that they don't know the exact number? So a long way of saying, if you go to my website and do an online application, I can pull your credit and run it through Desktop Underwriter, and we have findings. But I don't know anything about you. I don't know if anything that you input in that application is accurate. So we're looking through there for the agent to say, does it look reasonable? Are they self-employed? Things like that. And the only reason being, for an agent in a perfect world, they want a cash buyer. If they don't have a cash buyer, they want a financed buyer with a big down payment, perfect credit score, one borrower, W-2'd, very simple, no moving parts, no things to go sideways. So we're looking there saying, hey, we got a husband and wife, both of them are self-employed, separate businesses. They've got money in 10 different accounts, and some of them are retirement accounts. It just starts getting more complicated. So in the context of this question, does it put you ahead of other potential buyers? If everything looks really solid, we've got one borrower, excellent credit score, salaried income, not a lot of debt. We don't have, like, you'll look down in there when I'm going through it, if we have a debt that someone else pays, I can exclude that debt. If I see a janky looking file that has a bunch of excluded debt, you just know it doesn't mean the person doesn't qualify. It just means it's not a clean and easy file. So if an agent says, hey, I got 3 offers, will you look at these 3 DUs? Usually you can tell one of them, the loan officer doesn't know what he's doing or just is careless. And the other 2, you're going, okay, which of these 2 is the better or stronger buyer?
Good stuff. Renell. Hello, Jeb and Josh. When is the best time to tell the landlord that we are moving out? After the underwriter approved the loan? ? No, not in my opinion. I'm probably a little more on the cautious side. I've talked about this before on the lives. I don't think you should tell your landlord that you're moving out until you've released the contingencies on the property, till you've 100% committed and made that decision that you're moving forward with that transaction. Now, you might have already moved forward mentally anyway, but you lose negotiation, you lose leverage power when you start doing things like that before the deal's actually in stone, in my opinion, because if something comes up, repairs or whatever it is, and you've already told your landlord and you're negotiating and the seller says, no, I'm not doing that, you're like, well, I guess I got to move forward because I'm already moving out of my property, that sort of thing. So just don't put yourself in a position where, you have to move forward with a transaction because you've told your landlord that you're moving out of the property. And the other thing is, people do this early on. In some cases, they're like, I found a property. Great. 3 days into escrow, I'm going to tell my landlord. And then day 10, the deal falls apart because of whatever reason. The landlord has said, you know what? I've already found another renter for the property. Now you're in a position where you have to move twice in some cases, or try to figure something out, or forced into something quickly in trying to find the right property without time to really consider it and what have you. So just take your time in doing it. Don't rush. You're overpaying a little bit on both properties, but that peace of mind is worth it, in my opinion.
Hey, Jeb, we got a question from one of your normal viewers.
Oh, no, which one is that? Who's normal here?
Graciel.
Who's normal here?
Graciel is a regular viewer here with a good question here. Currently in escrow for new construction, when would be the best time to hire our own home inspector, during the first visit or final walkthrough? So you've told everyone here 1,000 times, even if it's new construction, still get your home inspection. There still can be some things there. You have the warranty that's going to cover you, but this is really just, what's the timing? When should they do it?
Once the construction company says the property's done, right? I mean, so you shouldn't be in a position really walking through that property in most cases until the property's complete. Now there'll be, you'll have an opportunity to walk through and check things and whatever, and they'll come back and fix them. But yeah, I would say prior to the final walkthrough, the final walkthrough is that time that you want to verify that all the information that you requested from those requests for repairs were actually completed, right? So no different than buying a house, probably 30 days out. When you start your loan, when your loan is actually in the process of being underwritten and that sort of thing, is probably a good time to do the home inspection on that property. Even if it's new construction, right? An inspector can walk through and pick these places apart in a lot of ways. And as a home buyer, sometimes you're buying property that's bigger than what you need. You're not using every room. And so some of these things you may never come across unless you are actually, getting an inspection. I mean, most home buyers don't have the ability to be able to check electrical outlets and look under a sink to make sure the plumbing's done correctly or what have you. And now, while new construction in the state of California has a 10-year home warranty for the most part, I believe is what it is, or it was at one point, they're required to fix this stuff. It still makes sense to pay $300-$400 to get it done, in my opinion. That way, when you move in, it's all done. And you have some leverage against the builder saying, listen, I'm not going to close until this is completed, which makes, when you move in, your house is ready to go and you don't have to worry about it. So the easy answer is before the final walkthrough. The final walkthrough is there to make sure that anything you requested was actually completed. We got a lot of questions on, we got some insurance questions floating around out there about a lot of, different things here. Josh, I got one for you though. I'll try to find the beginning of that thread on the insurance and see where that rabbit hole goes. What's the impact on mortgage if I rent out a basement while the house was bought without any rental mention? So I buy a house as a primary residence. I say, you know what? It's got a basement. I'm going to rent it out. Who cares? I'm asking you, who cares?
There's a couple of questions there. The first one is, hey, do I have a problem if I rent out the basement, if I rent out my master bedroom, if I rent out a guest bedroom, if I rent out that ADU in the back? You are only saying when you take out that financing that within 60 days of closing, I intend to occupy as my primary residence. So if you're occupying as your primary residence and renting out the basement, you are absolutely fine on that. We've got absolutely no issue whatsoever. So let's look at the flip side of it. When could it be a problem, or when might it be a problem? Is if you didn't move in. So if you rented out the whole property to someone and never moved in, the lender's going to have an issue with it if you never followed through on your occupancy certification and actually move in within 60 days and occupy as your primary residence. Now, if you live there for a year and you're like, I don't like this neighborhood, or I won the lottery, or I got an inheritance and I bought another property, or I inherited another home, I want to go live in that, you're not signing any agreement that says I'm going to live in that property forever. So you can always go about renting it later on. So in terms of, the question earlier was, can we use rental income to qualify on an ADU? We can't on an ADU on a purchase, and we can't on renting a basement either. But as long as you qualified and you occupied as your primary residence, you have no issues whatsoever.
All right. I like the answer to that. Let's see here. So I'm not even going to try to go down that direction, pronouncing that. Sorry there. I leased back my new home to sellers for 2 months. A security deposit was kept. If I find any minor move-out damages, can I itemize the repair charges towards deposit, or can the seller push back legally? Yes, you can itemize them. Can the seller push back? Yes. But, typically what I find in these scenarios is people overthink this whole thing. Most sellers, don't want to have to deal with this. They left the deposit there. It's like renters, right? They're probably going to keep the property in good condition. But you as a landlord now, get bids on stuff, show them the item. You might have a seller push back and want to get their own person to fix it, or find it for less and pay you less out of the deposit and what have you. And it becomes a negotiation. But unless two parties agree to it, that money's going to stay in escrow, and you're going to fight over it. So better to try to work together to come to a resolution. And I think the insurance question came up earlier because we were talking about renting a property back to an owner and what happens with security deposit and repairs and all this good stuff. And someone mentioned in the chat about having renter's insurance, right? So when you decide to rent your property out, there should be rental insurance during that time that the property's actually a rental. But keep in mind, if you're got that rental insurance, minor damages are done, it's going to cost you more to file a claim, deal with that, than it probably is just to try to resolve the issue. Now, if you have big issues that really require the insurance, that's a whole different animal. But filing claims with your insurance is never a good idea unless it's absolutely necessary. There's a lot of things that happen. Insurance rates go up. It happens too many times. You get your insurance carrier dropping you and what have you. Not saying don't use it. Just know that, if we're talking about minor repairs, which is what I would guess in these cases, because you are still going to do a final walkthrough in most cases, right? So, you're going to do a final walkthrough prior to closing on that property, which in a lot of cases means that you're going to see it, within a couple of weeks of it actually closing. So the chances of something major happening during that time frame, unless it was done intentionally, is not I would say is probably on the low end percentage of actually taking place. But who knows what can happen out there.
Hey, Jeb, John's got a comment here more than a question, but this is an interesting discussion that my buddy and I had when I was out in Texas. Let's come to Texas. If you think California property taxes are high, try $1,200 a month for a $500,000 house just in property tax. So for us in California, most areas, our standard statewide rate is 1%, and then every locality has their little stuff that usually takes it up to the 1.25% range. So Texas, 2% would be low, and some of them are up almost as high as 3, maybe even into the low 3s. So I was in April and went out and visited one of my buddies in Fort Worth. We went to Billy Bob's and saw Midland, had a good time. But we were just going to get a hotel. And he's like, absolutely not. Come stay at my condo. And in California, when you hear condo, we're like, it's 1,000 square feet. You're not in a lot of elbow room. We get to my buddy's condo, it's 3,000 square feet. His yard is probably as big as mine with my 6,000 square foot lot here in Huntington. So the discussion came down to that. His condo's worth about $500,000. His taxes are 2.5%, so about $1,200 a month. $14,000 a year. So we kind of got to the discussion of, okay, so what's better or what's worse? How much money do you make? How much do you save on not having any state income taxes in Texas versus the high property taxes? So to get something equivalent to my home in Texas, where he is in Fort Worth, the things that I liked were around TCU. You're still looking over $1 million, and with those property taxes, you're going to pay $25,000 a year in property taxes on it, if not more. So you go, how much do I pay in state income taxes? So the conclusion that we came to on that, for those of you thinking of leaving California to Texas, or Texans thinking of coming to California, while you're working, if you make a lot of money, you're probably better off being in Texas. But someday when you retire, retired Texans still have to pay those monster property taxes. In California, we got Prop 13 protecting us. And in theory, in retirement, you're not going to make as much money and not get taxed as much on your income taxes. So that's before you get into the whole California versus Texas debate.
Yeah, and these dummies that run the state here in California are every year trying to vote out Prop 13 for whatever reason. So hopefully these, that never actually comes to fruition, but it'll be on the ballot for the rest of my life as long as I'm in California. It's crazy.
Only every third election.
Yeah, exactly. So YouTube Car Spotters Guide has an interesting take as well. It says Prop 13, best thing, the house that just sold in La Jolla for $35 million makes up for grandma. Yeah. So, houses are selling at record highs now, and that $35 million house is going to be assessed at, $350,000 in property taxes. Base, plus any bonds, any other crap. So you're talking big change there for property taxes on a property like that. Imagine something like that in Texas. Your property tax would be like $10 million, or $1 million rather, a year. Not 10 million. That'd be a lot. Let's see. Anyway, let's get some more questions here. Let's see. Esther and Jimmy Andrews, considering listing our home for a rent to own, is that something that is attractive in this market? So I would ask you why you're considering a rent to own versus just selling it. A lot of times when you're considering a rent to own, you're setting a price, right? So you're setting a price now in a contract, and that buyer, or that tenant rather, that is going to be a buyer, or however you want to take look at that, there's a price that you're set to buy that property at some point in the future. Typically, the only markets that I see a lot of these is when markets stabilize, and or you're expecting maybe prices to potentially go down a little bit. You start to see a lot more of these, but I don't know in this environment why you would do a rent to own. So maybe let us know in the comments and give us a little more context on that. But being attractive in this market, I mean, you're definitely going to have tenants that would be interested in something like that because some people can't qualify for whatever reason, right? They don't have the income now. They don't have the credit now. Maybe a life event happened and they're not in a position to buy it now, but they say, you know what, if you're willing to sell it to me in 5 years, I'll be in a position in 5 years to buy that property. And so that's attractive to some, but I think you're in a market with low inventory, high demand. Unless you're getting something significantly better from somebody like that than what you could sell it for now, I don't see any reason that you would do that. And also that buyer has the option to not close on that property, right? I mean, if your price is X and properties pull back for whatever reason, that person that was doing the lease to own doesn't necessarily have to follow through. Now they might lose a deposit or money that they've thrown into it, but you might still end up owning that property. Now, Josh, you were going to say something?
So when and why are lease options or rent to own attractive to sellers? They're attractive in a market where it's hard to find buyers or buyers that will pay top dollar, because in general, who is the lease option attractive to as a buyer? It's someone who can't qualify for financing today but wants to buy, and they're trying to lock something in and start feeling like it's their home. They're most likely going to make you an option deposit. They're going to pay an above market rent, which is generally credited towards their purchase. So as a seller, you can get, if you're not dead set on selling, you can get an above market rent. Now, if and when they do exercise their option, the portion above market rent is credited towards their purchase. And generally, what are these people trying to do? They're trying to work through credit issues. They're trying to get a 2-year work history. Maybe they're going through a divorce, any number of things. So you're kind of dealing with a scratch and dent buyer, and what you're getting in return for it is a tenant paying an above market rent if they don't close and exercise their purchase. But we have a rapidly appreciating market. If you're okay not selling today, why not just lease it to someone at a market rent and sell it at next year's higher price, or 2 years from now higher price? Unless you have a home that's dated or otherwise unattractive in this market, if you can sell with a standard sale, you go ahead and do it. It's really a tool that's used in a flatter or more stable market, or someone with a property that's not quite as attractive.
Yeah, I mean, they go on to say they're expecting prices to level out soon. They want to get top dollar for the property. And we don't need to sell the property. Okay, keeping it too. So, you know, if you're looking to get top dollar, sell it. I mean, that is what you should do versus the lease option, right? And if you don't need to sell the property, you're okay with keeping it, then you need to make the decision one way or the other what your plan is, right? I mean, if I came to a listing appointment and you told me all of those things, I would say we got to figure out a solution here, right? I mean, if you're okay selling it, but you're okay not selling it, but you think the property is going to level out, but you want top dollar, like, where do you stand in this scenario? Because to me, you're not really a seller until you've made the decision that I'm going to sell. And maybe it's if you get X price or whatever that number is, then that's the way to go about it versus, in my opinion, doing a lease option. Anyway, we got some real good questions here. One is from Rishi Simply. Rishi Simply.
It might be Rishi. It's either Rishi or Rishi.
Rishi. I like Rishi. Why did I shave? I just couldn't take it anymore, man. I could not look at myself in the mirror anymore. My beard was going out versus down. And, you know, it just becomes one of those things. And Jeremy said I did it for the skinny jaw. And, you know, maybe I did.
He was fishing for skinny jaw comments, and he only got one.
You know, I actually got two. Jennifer told me I had a skinny jaw as well. I heard Jeremy earlier. So I didn't hear him. He can't talk in here. I did read that he was from Carolina earlier when I was going through this. So where in Carolina, north or south, and where are you from? That's where I'm from. So North Carolina, Kinston, good old Kinston.
He's the only person
We
from
produce more
yeah.
NBA players than any per capita, based on per capita, than anywhere else in the world.
And that's why his parents think he's a failure.
That's not the only reason. There's many reasons. That's just one of them. And you would think I would play better basketball, but we're not all gifted there. All right. Let's see. See something? Put it up there, Josh. Okay, here's one. Are Zillow homes really overpriced? So this is depends what you're talking about here, right? So Zillow obviously has their Zestimate where they put estimates out on home prices. In those cases, can some of them be overpriced? Absolutely. They're using, artificial intelligence, certain analytics to come up with the value on that property, right? By doing comparable search, trying to find comparables. In some cases, those properties are overvalued when you see them. Sometimes they're undervalued. So the point, what I'm getting at here is if you're looking at a value of a property, talk to a professional and not use that source as your only source. You can use it as a source, don't let it be the only one. The other way this question could go is Zillow is now a brokerage, right? They actually buy properties and sell them. And the question is, are they overpriced? Hard to say, right? I mean, in this environment, a lot of things that I feel like are higher than they should be are selling. So, Zillow is in a lot of ways, they're doing these cash offers. They're now doing iBuyer type programs where they're making offers on people's property. And in some cases, they're getting those properties less than market value and then turning around in a couple of weeks and doing carpet paint and some, maybe not even doing anything and just relisting them for more money. And, in my market, even those homes are selling. So I would say, it's hard to say whether they're overvalued or not. But in some markets they might be, but as a whole, I mean, they're a for-profit company. And so you're going to know, when they put out their quarterly results to shareholders, what's happening there. So, stay tuned and pay attention to that sort of thing. And you'll have a really good idea of how they're doing in as far as a brokerage and when selling these properties. Josh, somebody wants me to throw up your contact info, Freddie L. So you can throw it out there. Guys, we will throw that up at the end. Maybe let's do this. Let's talk about rates. Josh, what's happened in rates? What's happened to the 10-year? But before we do that, I'm going to ask a favor. If you're watching, you haven't already, hit the like button. Again, Josh and I are here every Wednesday. Sometimes Josh isn't here. Sometimes he is here and he thinks it's his channel. He tries to run the whole thing. But either way, hit the like button if you find the content valuable. It's helpful. It helps more people see it. Again, education is why we're here, to make better home buyers, better home sellers. And we appreciate you and would appreciate you doing that. So earlier we had a question. Actually, we had it 10 times, Kevin, like 10 times we had this question from you. Just kidding. But you're asking, my wife and I are in escrow hoping to close this Tuesday. Questions for Josh. How are interest rates looking? We locked in at 3.1, basically conventional fixed rate with a FICO at 744. Did we lock high? So answer that question, I guess, if you want. I mean, obviously there's some pieces to that missing, but where are rates, where are they headed, all that good stuff.
So just so everyone knows, there's about 40 different factors that go into a rate quote. So people always want to say, hey, I have a 700 credit score. What's my rate? Hey, I've got a 650 credit score. What's my rate? There's more to it than that. So Kevin's situation, to accurately answer whether there's a good rate or not, we have to know how much of a down payment, what type of a property would be the two things. Condos less than 70 or less than 25% down are going to be a higher interest rate. The more you put down all the way down to 40%, the interest rate is going to get slightly better. So that question is very hard to answer. Is 3.1 a bad rate? No, it's not a bad rate. The question then becomes, if you paid 2 points to get that rate, it's not such a great rate. If you got a 2-point lender credit, it could be the greatest rate ever. So there's a lot of things that go into that. Hopefully, when you were talking to that person and they were quoting you, they were showing you those options of saying, here's what happens if you pay a point. Here's what happens with 0 points. Here's what happens if you want a lender credit. And you can see that cost today and over time, because that's in essence what you're doing. People always call, Russell, one of my loan partners, spoke to a lady yesterday, and she called her current lender and then called him back, hey, we're going to go with them. They have a much lower rate. Well, they were charging her $14,000 in points because that's what call centers do. They're going to say, hey, look, we can get you this great rate. We can do a lot better than that. So all of those factors come into play, and including the closing costs. We've talked about this before. A lot of direct lenders are still charging $1,000 or $2,000 of lender fees, whether it's underwriting fee, doc fee, admin fee. A lot of lenders don't charge them anymore. On the broker side, we don't charge any of those fees. So a lot going into that. But that question was really specifically about where are rates actually today, or on in that situation. And then let's look here, bigger picture, where
this guy has a question. I threw his face up.
That guy didn't shave. He doesn't have a skinny chin.
No, dude, that guy's got a skinny chin, bro.
I don't think so.
Anyway,
I'm just trying to get over here and show our little chart here, and it is not showing up. There we go. So in big picture, all this, you see this means rates really going back to April have not gone anywhere. This is rates getting better. This is rates getting worse, better, worse, better, worse, better. Last week, worse. But everyone is watching the headlines and going, hey, rates hit the lowest levels of the year. But did they? We were actually back here in May. So this is just really a sideways trend. We're above these moving averages, which tells me that rates are probably going to get better. But when they're this low, it is really hard for rates to move much lower. So just be really careful when someone's telling you, we're at the best levels, you need to lock today, or, oh, the market sold off, we really need to get you locked. What someone is trying to do when they're pressuring you to lock versus advising you and giving you pros and cons of what you should do is hoping to get you off of the market, that when you lock that in, you complete your disclosures, you complete your application, that you're not going to go elsewhere. So right now, not a huge risk one way or the other. I'm not super scared about them getting a lot worse. I'm not super hopeful about them getting a lot better. For most of our well-qualified conventional borrowers, we're locking rates under 3% now with 0 points and 0 lender fees. For FHA borrowers, 0.0 lender fees with a 680 plus credit score is going to be down around 2.25. With a 640 credit score, you're still in that 2.5 range, and we can get you big lender credits with a 2 3/4 interest rate. So the answer is rates are good and they're trending lower. You can kind of see it in this. If we went back out to a 6-month chart, this is where we were back in March at the worst levels. So if we drew a line here, you can see bond prices have been kind of trending up, which bond prices going up means interest rates going down. So in the big picture, we have a trend in our favor, but there's headwinds just in terms of rates are really low and we have some inflation figures. Yesterday, this will tell you that the market wants to work lower. When we look yesterday, we were expecting CPI at 5%, which is really high. It actually came out at 5.4. Today, PPI, I don't even remember the exact figures. PPI is the producer price index. And we were hoping that would be a little bit more moderate and rates might improve. Well, it was also hot. But if you look here at the candlesticks, the market didn't move really in the last 2 days from a pretty damn good level based off of really high inflation figures. So the bond market, mortgage rates are telling us we're not super concerned about inflation. We're concerned more about the economy and what happens moving forward and with all of the government debt that we've taken on. So if you're in the market and, I believe Kevin was saying, hey, we're looking to close on Tuesday, you have to lock at some point. We can't get your loan documents out without an interest rate lock. So you don't really worry about it. If you've been writing this for the last 30 days, from mid-June through July, rates didn't really go anywhere. So we had an opportunity to lock here at a bad rate. We had an opportunity to lock here at the best rate, a couple times at the best rate. It doesn't matter. We haven't seen a lot of movement. Everyone that's locked in the last 30 to 60 days has got a great rate. The most important thing is getting a plan together of knowing why you're selecting that interest rate, what you're paying for it. A few weeks back, we had a question. We went through the loan estimate. When you get your loan estimate, the things that your lender or your broker controls directly are the box A items. Those are charged by the lender and or the broker. So if we want to compare a note rate, if you say, hey, I got 3%, was it good? Well, if there's $10,000 of charges in box A, probably not. But if you had two other quotes and the other one was 12,000 and the other one was 15,000, we can say that the lender that's only charging 10,000 is the best of those three. And if you shop two or three lenders, it's a pretty competitive market. So there's a reason for why you're there. So get a loan estimate. The loan estimate does not do a good job of advising you and showing you multiple different options. So hopefully whoever you're working with is going through that and comparing and contrasting different options and showing where they're at over time. But in terms of interest rates, rates are great. They're trending lower. I think they will go lower through the rest of the year. But whether it's a purchase or a refinance, if it's a purchase, it's time to lock. Lock it early in the process. When you see one of these high days in bond prices, lock it and take that stress out of the equation. If you're looking at refinancing, if it makes sense to refi, let's not wait for the world's perfect day. When it makes sense, lock it, move on. What I tell people is 2 months after we've closed, when I call people and go, how are you doing? If I ask them what their interest rate is, no one remembers. On the day you lock, it's the most important thing in the world. 2 months later, you've forgotten what it is.
Yeah, and again, it's one of those things that, if you lock it low and rates go up, you feel like you did something great. And if you wait to lock and rates go, did I say that right? Go higher, then you feel like you should have locked it. So you're going to be on the losing side if you continue to always look back at what you should have done. Make sure you're comfortable with the payment and then move on. Right? Don't get caught up in trying to pick the top or bottom. People are awful at trying to time the market, whether it's interest rates, stocks, home prices, or what have you. Be comfortable with the position and move along. So anyway, let's see what we got.
I got a good one for you.
All right, let's hear it.
Manpinder28 says, does a charter school in the neighborhood impact on the price appreciation? The neighborhood where I'm looking has an under construction charter school. Public schools have greater than an 8 rating, and I believe that's 1 out of 10. So I'm thinking that means pretty good rated schools, but a charter school going in. How does that impact it, Jeb?
Depends. That's one, here in Huntington Beach, like we're one of these cities that a lot of tracts, when they were built, were built around schools, or schools were then put into the tract. I don't know which direction it happened, because a lot of these, were built in the 60s or what have you. And I don't know when the schools actually went in, but there's a lot of neighborhoods that have schools in the actual tract of the homes. And so there's pros and cons, right? One of the pros is that it's easy to walk your kids to school. And where I'm talking about, the schools are all good, right? 8s and above. And so one of the pluses is that you can walk your kids to school and ease and access and all of that good stuff. The downside is if you don't have kids or whatever, and or the traffic that comes into the neighborhood and out of the neighborhood. And so there's a lot of factors that go into it. It's not as simple as, hey, does a charter school in my neighborhood make values go up? Some people that want to go to that charter school, because not everyone is going to go to that charter school in that neighborhood, right? So some of those people, it's going to be really nice, right? My kids go to the charter school. It's new. It's, it's really close by. I don't have to get in a car. Great for them. The people that don't want to be around that for whatever reason may not consider that neighborhood for other reasons, or for those reasons rather, may consider something else. So I would say that I don't know that it's a pro or a con either way. It's going to impact the people that are buying in that neighborhood in most cases. So it could go either direction. I would say if the schools in your public schools weren't that good and a charter school was going in, maybe that's more beneficial to that neighborhood. But it sounds like if you're 8s out of 10s, that's pretty good numbers for schools to begin with. And I don't know that a charter school going in a neighborhood is really going to change too much. So it's just going to maybe impact who's buying your property. And you might have somebody that's willing to pay a little bit more to be in that neighborhood for that reason. And at the same time, you have somebody that's not willing to pay that extra premium to be in that neighborhood, because quite frankly, they don't want the traffic and everything that goes along with it. So it's all about finding the right buyer that wants that.
So you guys all think that Jeb's just my friend and a business associate here.
What's he throwing up here?
But once upon a time, what was it, 3-4 years ago, Jeb was my realtor and sold me 2 houses. And Jeb, those 2 houses over there, was it Glen Drive? Is that where we got them?
I don't remember the street. Yeah.
It was in Anaheim, and not the greatest part of Anaheim, not terrible, but not the greatest part of Anaheim. And that neighborhood, a few years before that, had a charter school go in, and the neighborhoods around there, because they didn't have the best schools, the charter school definitely impacted prices, just in terms of the charter school that can draw from a pretty big area. So you don't have to be right next to it to go there, but being closer to it is better than being further away from it. Right. And we bought those two from Jeb. We bought another one over on the other side of the same neighborhood, and both of them at that time, was before the market went nuts, both of them did appreciate better than some other neighborhoods in Anaheim, but it was because they didn't have great schools until that charter school went in and parents wanted to get near to it. So like Jeb said, with an 8, I don't know this can make much difference. If you have great public schools, parents aren't dying to live close to the charter school.
Well, the real question here is, Josh, do you wish you still owned those 2 properties based on where you sold them?
Yes. Can I get them back? Can I get them back for what I sold them to those people for?
Let's see here. Here's a good question. John has thoughts on Jerome Powell's talk today. Seems likely that the Fed will pull back on the buying of mortgage-backed securities by year's end. Josh, thoughts on that? Easy, simple answer here.
Mortgage-backed securities were up 25 basis points today. I don't think me or the market are worried about the Fed backing away. They will, and they're going to telegraph it, and they're going to do it slowly.
There you go. I think, and I think that's the best answer, right? They can't move very fast in anything they do. Otherwise, it makes a big wave that affects way more than just home prices. It affects everything. So anyway. Jeremy came back and said south of Asheville for those Hendersonville. I actually know where that is. Anyway, nobody else cares. Sorry.
Do they have more NBA players than Kinston?
No one per capita has more NBA players coming out of high school going to, that came from high school in Kinston.
Do they have
I think there's like 7. There's a documentary that came out. I haven't seen it yet. It's called In the Water or something in the water, something along those lines. If any of you guys know about it, put it in the link because I'd like to watch it. But anyway, Netflix? It talks about the number of players, and I think it's the highest the city that produces the most NBA players per capita. So based on the number of the population there, which population's low, maybe 20,000, 40,000, maybe 40,000. I have no idea what the population is. Anyway, it's low. And I think at the time there were like 10 people playing in the NBA. Anyway, we'll move on. I'm looking at the population. I just want to see how
about famous actresses like Jamie Presley?
20,000 people. And then let's see how many NBA.
10 NBA stars and 1 TV actress.
I wouldn't say stars that played in the NBA, but some of them are stars. Let's see here. 1 in 52.7 basketball players that hooped at Kinston High have played in the NBA. 1 in 52, Josh. That's a lot, bro.
Which years were you on the team?
Never. Couldn't make that one. Anyway, let's move along here.
Hey, we got a couple of good ones here. A couple quick, easy. Michael Dury, we don't close until November, December. When should I start to compare lenders? Probably about 45 days. When you get within about 45 days, and you don't need to call a million lenders. You already have a quote and you like the lender. Talk to 1 or 2 additional. Talk to a broker. Talk to a local bank and compare them to those 3 and just see where they're at. And if you like your guy and you think he's high, show him the numbers you got and give him an opportunity to earn your business and win it. People feel like, for the most part, they should be putting their best foot forward. But if you really like that person and feel like they're the best lender for you and the best expert, there's nothing to say they can't match the terms from another lender if there's a significant difference.
No, agreed. 2 things going on here. Grace is asking another question here that I think is good. You can always float down with regards to locking your interest rate correct. So she's asking a question here. If you lock your loan, interest rates get better. Will the lender float you down, Josh?
So remember, in Graciel's case, they're buying new construction. So a lot of times when you're dealing with the builder's lender, they want to get you locked in. They want to get you to stop shopping, and they do offer a float down option. They say, hey, let's lock the interest rate today. We'll do a 6-month lock. It looks terrible. And they say, hey, when we get within 30 days of closing, if rates are better, we can get you that. On a normal purchase with a normal lender, you're not going to have a float down option. We have a couple of wholesale lenders that offer it. You don't get anything for free. There's a cost to locking loans for the lender. So if they're offering you a free float down, basically giving you a heads you win, tails you also win, there's going to be a cost in terms of a higher interest rate to begin with that.
Sorry, I was reading something there at the same time. I'll get to that one in a minute.
As long as we're on the interest rate ones, we got another good interest rate question. John pops in here with what is the cutoff in terms of rate lock period where you won't be penalized for a longer rate lock, meaning you pay X rate at 0 to 30, 0.5 higher at 30 to 60. Rule of thumb, just lock at 30 days. So if the market, like we're seeing, is trending slightly better, or it's flat and we have a longer term time frame, we always want to get inside of 30 days. It's nice to be locked. It takes the stress out of the situation, but every longer term lock, every extension that you go. So the shortest term lock we have is 15 days. So after a 15-day lock, a 30 is more expensive than that, a 45 is more expensive than that, and a 60 is where you start seeing the cost trend down. It's pretty much linear between a 15 and a 30 and a 30 and a 45. Once you start going from 45 to 60 and definitely beyond 60, they start getting much more expensive. So in a perfect world, we get within 30 days. If you're happy with where the interest rate is, take that. Now, when do we use a longer term lock is when, instead of this trend where we're seeing higher bond prices and lower interest rates, is if we're seeing the other trend that's just leaking out on you and you're losing, 1/8% in interest rate in a week, just go ahead and do a longer term lock.
Awesome. So Jennifer gave us a super chat here. Jennifer saying, please hit the like button. She gave $4.11. What's the significance of 411?
It's the 411, bro. She gave you the 411.
But she could have done $4,110 and it would have been the 4110,
I don't know.
We could have done a lot of variations here. I don't know that it was the 411, but maybe.
So
she said hit the like button. Do that for Jennifer.
Rishi's got jokes. She comes back with, did Josh just advise to go with the lender if he's high? I would absolutely never advise to go with the lender that's high.
No, never.
No. They tell them to put the weed down, even if they're in Colorado or California or in areas where it's, how's your mother now making insults to North Carolinians?
No, they're just saying basketball's stupid. Real men play hockey. I can't really argue the whole hockey thing just because those guys are crazy. But Josh played basketball and he's not really a real man either. So I get it. Yeah, I get where you're going with that. He told me today he was going to retire. And so there was a question on here about Josh being their lender in 3 years when they purchase. Richard, I'm sorry. Josh said he was going to retire today.
4. I said when our lease is up, that's 4 years. So you'll get in just before we're done.
He's not retiring. I bet you Josh is here. Maybe not doing YouTube, but Josh is in the business in 15 years. 15 years, Josh is still doing it.
We'll be doing a live on the VR headset and we'll just be prancing around the room and all that stuff.
Maybe. Let's see here. So Man Pinder 28 has another question about casino. So the same neighborhood that the charter school's going in also has a casino.
God giveth with one hand and taketh away with the other.
That's hilarious. How does that impact the price appreciation? I would say it would be very similar to not to the charter school, because I think this has a bigger impact. I think it would probably hurt the values of the neighborhood homes, in my opinion, for the most part. A big industrial, commercial type space coming into a neighborhood, probably not the best. But again, if you find a buyer that wants to be near the casino and maybe they're a degenerate and they just love to gain, like that's where they spend their time every waking hour, then maybe they'll pay a premium for that. But I would say that's not the majority of people out there. So I would say that would probably have a more of a negative impact than a positive one. But if it's in an area that has been run down for a long time, and they're coming in and regentrifying the area and redoing buildings and adding businesses and creating opportunities and that sort of thing, then maybe it's a positive, right? Because now you got charter school, maybe you got new businesses, which means more jobs, growth, all of that good stuff. So I would say case by case basis. Too hard to tell without really knowing the full scope of the city and all that's going on there. Josh, find one for us here.
Jennifer didn't give more 411. She came with a question on this one.
All right.
What is the basement price lenders will allow? I've heard some will not write for under 60,000. So she's literally asking, what's the smallest loan a lender will make? And it is two things. So there are laws of what's the maximum that you can charge. Now, if you want a $25,000 loan, it requires just as much work as the guy that needs a $250,000 loan or a $500,000 loan. So thankfully, under $100,000, it goes up what we can charge. But let's say again, a $25,000 loan, the maximum is 10%. It's $2,500. So that loan, the $300,000 loan at 1%, we're making $3,000. So same amount of work. So what happens is in that 10%, it also includes certain other charges. So you have a maximum of the total costs allowed in there. It becomes really, really hard compliance-wise for lenders to make those loans. So what you see is in a lot of lower priced areas, you have local banks that end up doing most all of the loans, and they're doing it on a relationship basis, because for us as a broker, for bigger national lenders, it's really hard to be compliant and do a loan under $70,000, $80,000 profitably. So we don't have a rule against doing them. And I think we did a $50,000 or $60,000 one a couple of years ago. We were able to make it work and be compliant and make the client happy. But don't feel like it's a matter of, oh, they're discriminating against people that need little loans or they only want to do big loans. It can be really, really difficult to remain compliant with the government regulations post meltdown and do the little loans.
All right. Ray said that in Highland, California, near San Manuel casino, home prices appreciated with the opening of the casino. So in some markets, you might see it, right? Each one's going to be a little bit different. Now, earlier I saw a question, and I don't want to scroll all the way up to find it, but someone asked about which apps to use. Like, as a real estate agent, which apps do I recommend buyers use when searching for property? Hard to say. So here's what happens. We input information into our multiple listing service, MLS. That information syndicates to all of these different websites, right? To Realtor.com. It syndicates to Zillow, to Redfin, to Trulia, to every other site that you want to consider, right? So all the information originates one place for the most part, and then syndicates to all of these other places. The problem you have here is now some of these sites that were primarily there for home buyers are now competitors of us as real estate agents, i.e. the Zillows of the world. Even Redfin has their own brokerage, right? And so they're competitors now. And so what happens is some brokerages, I work for Coldwell Banker, but like a smaller brokerage might exempt themselves from sending their properties to these brokerages because they're saying, hey, look, that's a competitor. We don't want our property showing up on a competitor's website now. Whereas prior to, the last couple of years, it was never a big deal. It was, all informational purposes. It just got the property in front of more eyes, so on and so forth. Now you have people taking a stance saying, listen, I don't want my properties to show up on this site, so therefore I'm not going to allow them to do it. So some of these websites, for example, like those, may not show all of the property out there for whatever reason. So, what I will say from a fancy perspective, which one is the best looking? Redfin's website dialed in. Their mobile app, they do a really good job with it. They really can make you believe that you're making a tour with the property with the listing agent. In fact, it's one of their agents. So just understand that anytime you click on one of those things, you're giving them permission to have people contact you, right? I would say at the moment, Realtor.com is probably the least biased in any of this stuff and just provides information from the MLS. It's not as pretty as the Redfin, if you will, as far as the app goes, but the information is just as good. So I would, it depends on what your flavor is, right? I talk to buyers all the time. Us as agents can set you up with the ability to do that. Some agents have their own apps as well, or have the ability to set you up on a search through an app and all that good stuff. So I wouldn't say there's a right or wrong answer. Just understand that what you're looking, that make sure you're just getting the information that you want to be able to see. I'm a real estate agent. My wife has access to pretty much anything I have access to, but yet she scrolls Zillow, right? That's her deal. Like, she's on Zillow looking. So just go with whatever you want. But there was another good question here from Ricky. Ricky said, buyer's letter to seller, yay or nay? Our agent says no due to possible discrimination, and listing agent won't look at offer. So Fair Housing has made, kind of a stance saying that buyer letters, love letters, whatever you want to look at it, are no longer to really be considered when making an offer, right? Because it allows the seller to, could discriminate based on the information you put in there. Some people put pictures in, some people put, information about their family or lack thereof or what have you, and the seller may make a decision on that buyer because of something that was in that letter, and that is not fair housing, right? There's supposed to be no bias in fair housing. So should you or should you not? Talk to your agent, right? I mean, if your agent's saying no, they're not going to do it, that's one thing. You might say, hey, as a listing agent, I ask my clients, seller, are you okay with these? And they may say yay or nay. And if they're okay with it, then, it's one thing, right? And this is just for informational purposes. This isn't really happening on my side, but this is all I'm just telling lies over here. I don't really have that conversation. No, I'm kidding. No, I ask sellers, I say, are you okay with having letters sent to you? Yes. Okay. Send them in. I get offers. I send them to the seller. But one thing that you're not supposed to do now is really talk about yourself, right? I think you can do a letter to the seller talking about the property, talking about upgrades they've done to the property, that sort of thing. Helps your offer stand out. You don't have to get personal about you, your family, all of that. So they're still out there. They're still floating around. As a listing agent, I still receive them. And I'm supposed to pass information along to my client that I received, part of my job. And if they're okay receiving them, they get them. So
what about pictures, Jeb? Can I put a family photo of me and my 2 children and my beautiful dog and my lovely wife?
Well, first off, you don't have 2 children. So
shit.
That would be, did you Photoshop them in?
I Photoshopped them in.
Yeah, I think you should. That would, yeah, absolutely. Just send it like 10 kids. 10 kids and you need a house, and this is the only one that fits that bill. Yeah, pictures aren't really supposed to be done these days. So no, I would say I would recommend against a picture, or I would advise against a picture in there, and advise against any personal information about yourself. Really just focus on the property itself if you're going to do it. And if you work for fair housing, you should never submit a letter with a buyer. If you're watching this.
Just sanitize it. I am a person in California and I like your home.
Yes, exactly. And if you want more information, reach out to me. No, this is a true story. One of my clients, I was selling a property. One of the buyers, this was like right at the beginning of this whole thing. He actually took the letter and dropped it off on the doorstep of my client's house. So it never went through the agent. You can't stop a buyer from doing what they want to do. And it made it directly to the seller. So maybe that's a different approach on how to do that sort of thing. So, think outside the box, if you will. Let's see.
Jeb, let's bounce a couple of these here. So there was one earlier. So Lavanya Kakumanu, how about the market in San Diego? We have one here.
Good, Josh.
I try. Catherine AA says it's a bad idea to buy a house in the Northern Virginia area. And we had one earlier that was, what do you think about the market in Lancaster, Palmdale? So what I will say, so for us in California, Lancaster, Palmdale is a lower priced area within driving distance of Los Angeles County. San Diego has been lower priced historically than LA and Orange County. So people who love the weather have most of the same amenities in San Diego County as we have up here. People, as prices have gone up, have gone down there and pushed their prices higher. So some of these areas that are adjacent to other areas that have gone up more, Jeb and I had talked about this. When Newport Beach around 15, 16, 17 got really expensive, Eastside Costa Mesa started going up as people got priced out of that. So you have some of these areas that are going to benefit from that. But in general, all of these questions that are saying, what about this market, this market, this market? All real estate is local, so you have to know your local market. I'm sure there are markets where the economy shifted. There's maybe some more problems or issues there where home values aren't doing well. But I think Jeb's going to say the same thing I will. We still have a lot of supply. We have the millennial generation coming into prime home buying age, and more of them coming to prime home buying age next year and the year after that. Rates are going to stay low. For a lot of them, home prices are still reasonable and affordable. There is no reason to believe the home prices aren't going to continue to go up from here. At some point, we will have a correction. There's nothing in the fundamentals of what's going on in the economy, work riot-wise, employment, incomes, interest rates that would cause home values to not support the decision to buy right now.
Something that no one's talking about yet is the recent study that came out, data that came out said, I think there was like $8 trillion in equity created in the last however many months or whatever. Baby boomers, right? These baby boomers were supposed to sell their properties, and that was going to be supply coming to the market. They were going to buy something less, blah, blah, blah. Didn't happen, right? So baby boomers are sitting on a lot of that equity, that trillions and trillions of dollars of equity that's out there. Those baby boomers at some point are going to pass that equity down to family members, right? To whether it's their millennial grandchildren, to whether it's their older children, whatever it is, that money is going to be out there, right? That gives home buyers potential to continue buying properties, even at what people might say inflated prices, right? So there's still a lot of opportunity for things to continue to move sideways to up. There's a lot of money out there, a lot of generational money that's not even in play yet, that might actually be the next leg that keeps this thing moving. I mean, who's to say, right? We don't know the direction that things go, but as affordability becomes more of an issue, I think you're going to see a transfer of some of this wealth to the younger generations, which is going to allow more people to continue to buy, maybe not at the prices that we're at right now, but somewhere close to them. I have clients all the time that are selling their properties and maybe not their primary, but other properties, and they're and the reason because is they're like, what? I want my children, I want to see my kids, my grandkids actually buy property. I want to see them do something with the money while I'm alive. I don't want to die and have the money go to them and never see them enjoy it. So if I can pass that money along to them now, see them have an opportunity at creating wealth through home ownership or whatever it is, they get the joy and satisfaction of seeing that. And then you have the millennial buyer and or the parents or whoever an opportunity to actually get into the real estate game. It's this whole cycle. And I think that's going to be something that plays a part in this. And we don't know how it's actually going to affect real estate and the market and prices and all of that, because no one really knows. I mean, because it's not all going to happen on one day, right? This is going to happen over the transition of the next, 15, 20 years as, more continue to age out. But anyway, kind of a tangent there. Let's just go silent. See how long we can just stay silent and stare.
I'm pretty sure it would go from 236 to 36 fairly quickly. Here's a good question. Jason Garcia has one here. Does refinancing your home's mortgage reset your 2-year primary residency tax exemption? Absolutely not. It has nothing to do with the financing on the home, whether you pay it off, take the biggest loan in the world. If you took all of the equity out of your home with a loan, it still doesn't affect the exemption.
And what he's talking about there is capital gains exemption, right? So as a homeowner, if you've lived in the property 2 of the last 5 years as your primary residence, you have up to $250,000 as an individual in tax exemption, capital gains, and up to $500,000 as a married couple, and that you can exempt on your taxes. So refinancing, doing any of that doesn't play a part in that. And in fact, you could turn that property into a rental for 2.5 years. After you lived in it. And as long as you've been there 2 of the last 5, you can still get that exemption as long as you haven't done it on another property within the last 2 years, I believe it is. Let's see. Ivan is asking Riverside, California. Pretty much the same advice Josh gave a moment ago. Not a lot's going to change. A lot of the people that are in Orange County, got priced out of Orange County, have moved to the Riverside market because it's been less expensive. That market has continued to accelerate, explode, appreciate, however you want to look at it. That's not going to change. As long as things, supply continues to stay moderately low, we're not going to see really a real impact on rates. You're going to see a market that continues to move sideways, and that's almost a tougher market than Orange County because of the number of people that are. The demand is almost higher just because prices are a little less than they are here locally.
Well, we talk about willing and able demand. Everyone is willing to buy Malibu beach houses. Most of us are not able to. So there's more able demand in Riverside County, Riverside City, Riverside County. The thing that I will say on that, the benefit later in the cycle, when areas like Orange and LA County have got priced out for a lot of people, you'll see greater appreciation in outlying areas. What Jeb hit on last week, though, is when the market turns, and we are not in any way projecting or thinking that it's going to or that's on the horizon, but when it does, those areas will drop faster because people would prefer, other things being equal, to live in Orange and LA County versus Riverside or San Bernardino County. So when prices start dropping and they become more affordable for people to live in the more coastal areas, they'll go back and gravitate that way, and prices will drop more in the inland areas.
Eddie has a question here. Parents are gifting us the house. Do we sell if we don't like it or keep as a rental? In Santa Clarita, which is here in California. So there's 2 things going on here. If your parents gift you the house, you're able to keep their capital gains. You're able to keep their Prop 13. Their property taxes based off when they purchased it. So if they purchased it 30 years ago, property taxes are really low, you're going to get the ability to keep that property taxes. Turning it into a rental negates that. You're going to have to pay market property taxes based on, Prop 19 that came into effect. So you're going to, that's going to change the dynamic of it being a rental property. So you have to decide whether or not it's something you want to live in. And if not, if turning it into a rental, does it actually make sense based on what you're going to have to pay with regards to property taxes and what you can bring in and rent? Your other option is to sell that property. So depending on how that property was transferred to you, there might be some taxes that have to be paid on that property as well, right, Josh? Or is that if it's done? Well, if it's not done through a trust, you're not
ever taxed as a recipient of a gift. Jeb, if I want to walk to you tomorrow and hand you $500,000, you're never going to pay taxes on that. The estate has an annual exemption of $15,000 per individual. So when Eddie says parents are gifting us a house, I'm supposing there's a spouse there, probably not, maybe children, but each member of that family from each parent can get up to $15,000 a year. Any gift above and beyond that comes off the lifetime estate exemption. I don't have the number up in front of me, but it's big. It's bigger than most homes are worth. So unless they gifted you a very valuable home, Santa Clarita prices are nuts like everywhere else. So I'm sure it's valuable, but you're probably fine. What they're supposed to do is track that for estate taxation purposes. So someday when they pass, that the correct estate taxes are paid, which again, under the current regime, the estate tax exemption is huge. So it won't be a problem
unless it's a couple million. I forget what the number is.
Yeah. Yep.
Yeah. So, there's a lot going on there. I would say the ideal situation, if the property taxes are low, that you keep it as your primary and be able to take advantage of that. Because that's definitely more than, that's where a lot of people end up paying a large majority of their monthly payment is towards property taxes, especially in this environment.
We've got a good one here, Jeb.
All right.
Peter Ortega, can you get out of a reverse mortgage? This is one of the biggest misconceptions. People will call and say, oh my God, my dad passed away and my mom took out a reverse mortgage when we weren't paying attention. Now we don't get to inherit the house. There's a reverse mortgage is no different than any other loan. In that situation, if they want to help mom get out of it, they can help mom put a traditional mortgage in place. The reverse mortgage, you would order a payoff demand just like any other loan. There's a note for the reverse mortgage, and there's a deed of trust or a mortgage that secures it to the property. You order a payoff demand, you pay it off with cash, you pay it off with a new loan, they reconvey that lien, and you're just fine. If you inherit it, we have a sale right now up in Lake Tahoe. Our buyers are buying a home that the family inherited, the trust inherited with a reverse mortgage on it. And they're at the far window of their time for when they're required to pay it off. I think you have 6 months after the death. So we're kind of rushing to get that closed. But same thing, escrow orders a payoff demand. They're selling the property. So the proceeds above and beyond the payoff of that loan, just like any other mortgage, will go to the family. If someone in the family had wanted to keep the property, they can move in, they can refinance, take out a new loan and pay off that reverse mortgage just like any other loan. So don't freak out if your family members get a reverse mortgage, want a reverse mortgage, need a reverse mortgage. It can be an appropriate financial planning tool for seniors who don't have quite enough to get by on. Just be very careful with it. We talk about high-priced lenders in here. Some of the most egregiously overpriced lenders are reverse mortgage lenders that are making $20,000, $30,000, $40,000 on those loans. So if you're going to do it, make sure you watch and check numbers with a couple places.
All right. Let's see here. Jeremy said it's 9 million as the number who will have the transfer occur. Okay, so 9 million will have the transfer occur in the next 3 years. So are we talking about the baby boomers? I'm not sure. Are we talking about the estate? Anyway, clarify for me, Jeremy. And you're in Fort Wayne, it looks like. I have actually a really good agent in Fort Wayne. Are you a real estate agent? It looked like you might be. I don't know if you are. Maybe you know him. Anyway, let's move along here. Would you sell if you had to pay long-term capital gains or wait until next spring and not pay? Leaving the state next summer worried about slowdown. So why would you
stop worrying about the slowdown?
Yeah. So thoughts on that, Josh? Paying long-term capital gains or waiting until next spring and not paying?
I think what he's saying is he's been there over a year, so it's currently long-term capital gains, and next year it'll be 2 years, and he can take the gains tax-free. So what Jeb answered the question a few back, if you've lived in a home 2 out of the last 5, you can take it without paying any taxes. So in this situation, I would absolutely wait until next year. We had another question here, someone asking, based off of one of our last answers, well, when's it going to drop and what percentage? Neither of us said anything about home values dropping. I have no reason to believe that home values will do anything other than appreciate for the next 2 to 3 years. Neither of us like to project out much longer than 24 months. So ask again in a year and a half, and maybe we'll feel different. But right now, demographics and economics tell us that home values are going to continue to go up. So I would never volunteer to pay taxes. And in this situation, Nicholas, we did this a couple months ago. I just bought a property in Orange. We could flip it and sell it and ring the cash register now and pay short-term capital gains, get taxed as ordinary income, or I can wait 12 months and sell it as a long-term capital gain, or I can wait 12 months and decide, do I want it as a long-term, or do I want to put it off even further? We're going to hold that property for at least a year because it's going to be worth more next summer than it was this summer.
All right. There you go. Yeah. I mean, I think, again, we've talked about values being higher as we continue to move up. Now, that doesn't mean they can't moderate. Doesn't mean that you might not see a decline in some markets.
They better moderate.
Well, yeah, I mean, but you're not, I mean, when we say prices are going to continue to go up, everybody immediately thinks that they're going to see that we're, predicting what's happened over the last year and a half. That's so far from the truth. I think, normal appreciation in a market somewhere between like 3 to 5%, right? I think that is realistic. I think you're probably going to see something like that over the next couple of years. As things continue to move sideways. Now, again, what I was saying a moment ago is that doesn't mean in your market that you might not see a small decline a little bit. I mean, it could happen, right? I mean, it's all based on desirability and supply and demand and all of that good stuff. So depending on where you're located, you might see some sort of slowdown. But I think as a whole, you're not going to see much change with regards to home prices. And we actually had somebody ask a moment ago about rents. Where do we see rents? Rents are going to continue to go up. There's no reason for rents to go down. In fact, you got a big portion of the population. I mean, the rental market. I mean, here in where I am located in Southern California in Huntington Beach, rentals are as hot as buying property. It is crazy. I mean, somebody contacted me a couple of days ago about trying to find a rental, and I think there were three total properties on the market that matched what they were looking for, and it wasn't anything crazy. I think they wanted something under $4,000 a month. So look at it there. I mean, inventory is low, demand is high, prices are going to continue to move sideways to up. So we're pushing an hour and 55 minutes here. Josh, find us a question and we'll make it the last one.
This is an interesting one. Matthew asked, do you think a lot of property was being held by inheritors from those who died of COVID, not needing the house but not wanting to sell? If prices start to fall, they will get spooked and sell. So refer back to the last answer. Neither of us think home prices are going to fall anytime soon and will continue to appreciate. So what did we have? We had 600,000 COVID deaths in the United States. About 60% of adult Americans are homeowners. So let's say 360,000 of them owned homes. And we have 140 million housing units in the United States. If all of them were passed on to heirs and they all sold, it would have no impact on our housing market.
Yeah, I mean, to answer your question, do I think there could be people holding properties from inheritors? Sure, there could be, but I don't think that necessarily those properties are going to hit the market for the reason of people panicking. It's more people just wanting to take advantage of the opportunity of you got people selling, right? You got people selling just like selling the stock market. They think that there's a top, so they're taking advantage, and those people are going to sit on the sidelines and wait for prices to come down and try to buy something or what have you. I know people that did that in 2019. It's 2021 and prices have appreciated 25% since then in a lot of markets. So trying to time the market, we talked about it earlier, it's a fool's game. Be comfortable with your payment. Have money in the bank. Don't stretch yourself. Stick to a plan, budget, whatever you want to. Watch the video that I did today. Those things are important. That's what you should be focusing on if you're buying a property, because if you do that and the market goes sideways, things change. Guess what? You don't have to worry about it. There's nothing to concern yourself with because you've done the things that you need to do in order to be in a good position. And I did talk about that today in a video. If you haven't watched it, go check it out. And if you're still here watching, hit the like button. Share us with anybody that might be looking. Also, I started a Discord channel. I don't know what the hell to do on Discord. We could continue the conversation that we're having here, but in text format. So if anybody is interested in that, I'll post it on my dashboard on YouTube a little bit later to the invite if anybody wants it. And Josh, final parting words.
I want a final answer. I got a good question here. David pops up. Buy now with these low interest rates, but go over asking price by $65K, or wait until demand decreases with higher interest rates?
I want an RV, bro. I'm not paying $65,000 over.
In Portland, Oregon. So remember, the asking price is irrelevant. Jeb and I just had this conversation. Agents who sell one or two houses a year are just dying to tell everyone how they sold something for $65,000 over asking price. So the asking price is irrelevant. If the market value is what it is, and that's the right price for the home, I would buy with these low interest rates. Portland is, despite their politics, a very desirable area, and people will want to continue to live there. So nothing to tell us in the next couple of years that home prices don't continue to appreciate. And kind of like Jeb said, we both sit here and root for the Goldilocks housing economy. 3 to 5% appreciation. If it did that forever and never went down, most of us would all be pretty damn happy. You could have predictable profits. We might not have any audience here because people wouldn't have nearly as many questions. But
we would lose everyone.
zero reason to expect home values to go down in any time in the near future. And where I will kind of go with that, also, here's my final thoughts. You were talking about timing the market. I have some clients that bought in 2006. I told them, home prices are really high and we're expecting this market to correct. They had rented for the last 20 years. They had paid $250,000 of rent on their $200,000 rental. So they said, we're not doing it, we're buying. Those people bought, their home dropped $200,000 from what they paid for it. Didn't matter. They're professionals. They make money. They paid their mortgage. And now the home is worth twice what they paid for it. Have a long time horizon. Know that you're buying a home that you're comfortable living in, and don't worry about what happens with the market. It's not dropping anytime soon, but it will correct at some point, and we'll let you know when we see that coming.
No, good stuff. Racing. I'm too old for Discord. Dude, I have people said, hey, you should get a Discord. It's peer pressure, bro. So I did it. Now I don't know what to do with it. It's like something else I got to manage, man. So
I don't even want to know what Discord is. So stop talking about it.
It's like AOL Instant Messenger, bro. We're gonna go back there. We're gonna just chat with each other. It's great. More importantly, before we end this, we got 50 seconds before we've been on 2 hours. What do you guys think of this right here? Look at that guy in the corner. Big, thick neck, headphones on his head.
Skinny chin, strange shadow beard.
Yeah, look at that guy up there in the corner. What do you guys think?
I think there's another picture you should share with him, Jeb.
Which one? Which one was that?
Our outing this weekend. So
where is it? It's not there anymore.
Hold on, I'll get it back. Why? Oh, it's a Microsoft Edge tab. Here we go. Look at this crew. So Jeb talks about his wife house shopping all the time and trying to quadruple his taxes. So the one next to him is his wife, and the one next to me is my wife.
We typically don't stand next to each other's wives when we take a photo on the other side of each other.
And most importantly, they are not sisters, despite the fact that everyone asks them wherever they go, are you two sisters?
Yeah, there you go. There's family photos, people. Maybe next week you'll get the kids. Maybe next week.
That's what you don't get in Texas. That's why we deal with the California government to have pretty ocean pictures while you're drinking tequila on the weekend.
There you go. Anyway, guys, thanks for joining us. Hit that like button. Appreciate you being here. We will see you next week.